Happy Sunday. Hope you're all having a great weekend, and thank you for joining us this Sunday for Brunch with Brandon. We wanted to make sure to get you an update this weekend on the new Secure Act 2.0 that has now officially passed and is in fact law, and kind of reconcile some of the differences that we've seen leading up to the official passing of this version, and really give you some clarity behind what to expect moving forward, how it might impact your retirement, and what you may want to watch out for in the year or years to come. So I think there's really three primary areas that I wanted to touch on. The first is required minimum distributions. So when we think about this new Secure Act 2.0, there are some changes to RMDs, or required minimum distributions, on retirement accounts. There are some changes to employer contributions, how they can be made, where they can come from, that kind of thing. And third is extra catch-up contributions. So for those age 50 and older, you are able to put a little bit more towards IRAs and 401ks, and there's some new nuances, let's say, to what those changes mean, and some even additional amounts you're able to kind of sock away here based on the Secure Act 2.0. So let's back up here a little bit. The first thing I want to share before I get into these three kind of key areas is to refresh a little bit on the first Secure Act, right? Secure Act 2.0 would imply that there might have been a 1.0 at some point. So back in 2019, similar to this actually, the very end of 2019, the first Secure Act passed. And there's a lot of things to it, but maybe the most relevant, and where we'll start our conversation today, is that required minimum distributions were pushed back. So before the original Secure Act, when you turned age 70 and a half, the IRS, or you were forced to take money out of your 401ks and IRAs. All right, that is still the case, but what the Secure Act did is moved it from 70 and a half to 72. Now, fast forward to 2023 here with the new Secure Act 2.0, and there is even a further pushback. So basically, this plays out right away. So what the new changes are is required minimum distributions now begin at age 73, beginning right now in 2023. So basically, if you are 72 or older this year, you will be qualified under the new Secure Act 2.0 rules and the new required minimum distribution ages, and increasing again to age 75 a ways out in 2033. So there's obviously a little bit of a gap between this next bump, but definitely it can impact quite a few people right out of the gate who might be turning 72 this year. Second thing I want to touch on is employer contributions. This is a big one, okay? So employer contributions typically have come from a matching program, or maybe a discretionary program from the employer, but generally an employer contribution can come in the form of a match. So if you put in 5%, let's say, they might give you 3% towards that 401k. So all that is still pretty similar, but there are now some nuances that may allow for those who may not have typically been able to contribute to a 401k to actually get an employer contribution, and for those who really want to put as much away into Roth as possible to really lean in even more on that. So the first is for anybody whose plan allows, right? This is key. The plan needs to allow for this. Your employer will have to roll this out. But this has opened up the opportunity for employers to offer that your match be made in a Roth 401k format. All right. Now, as you might imagine, when your employer was doing this into the pre-tax side of it, they get a tax break, right? Now, for that, you pay the tax in the future when you take it out. But if the employer is going to give it to you on the Roth side of the 401k, what's really important to know is that you are likely to be taxed on that contribution. So keep that in mind. This isn't like a totally free benefit here from a tax perspective, but it certainly can open up a lot of planning opportunities. Second is for those who are making qualified student loan payments, your employer now has the option to open up that as well against your matching contributions, your employer matching. So in other words, if you're making payments to a qualified student loan and your employer wants to roll this out, they could offer a match against those qualified student loan payments. So that could be helpful, obviously, for somebody who can't do both, right? If you're kind of having a hard time paying off student loans and contributing to a 401k, this would allow you to get a little bit of best of both worlds there. Third thing I want to touch on is extra catch-up contributions. So right out of the gate in IRA accounts, there's now going to be a tie to cost of living adjustments. So in the past, the catch-up contributions for those age 50 and older has been flat, basically. What's happening now is they're going to tie that to the cost of living adjustment, or COLA, if you hear me say that again. Cost of living adjustment is what that stands for. So that basically it'll offset and kind of help keep up with some of the inflationary impacts, especially that we've been feeling lately. The second thing is for those ages 60 to 63, there will actually be an additional annual catch-up limit of all the way up to $10,000. So that is the biggest jump of these different scenarios. That's the one that creates a lot more opportunity if you fall in that age range. But what's also important is that particular $10,000 increase will also be tied to COLA, cost of living adjustment, beginning in 2025. So we'll start to see that continue to increase as well. Right. So again, the three biggest things for the Secure Act 2.0 that have changed are required minimum distributions. They're the way that your employer contributions can go into your 401k. And third is the extra catch-up contribution limits that are allowed, especially again for those age 60 to 63. Now, I would suggest that those are the three top things. If you're going to get anything out of this conversation today, definitely kind of keep those in mind. But I will share that there's some additional roll out some additional benefits to consider as well. One of them is for business owners. You now actually will have the ability to create a Roth, SEP, or simple IRA. So that's something that's new and something that's been talked about for quite some time is now going to be available. Any new retirement plans are going to require auto enrollment provisions for their employees. And third is that there actually, believe it or not, is going to be some provisions that allow transfers from 529 plans into Roth IRAs. Now, I'm not going to spend too much time on that here. There's a lot of restrictions when it comes to these options that you have with the the 529 to the Roth. But regardless, there can be some planning opportunities for you there, especially for maybe somebody who saved a bunch into a 529 and didn't end up using it all for their kids. Maybe they got a full ride or whatever the case might be. So those are some other nuances. There's a lot more to it than that as well. But again, if you're going to take anything away from our conversation today, just as a quick refresher, it is a delayed required minimum distribution. It is employer contributions can be made to the Roth side if your plan allows and or matched against student loan payments, and extra catch-up contributions, again, especially for those age 60 to 63. So I hope that's really helpful. There's a few more things that snuck into this bill, as you might imagine, towards the end of the year as well. So I'm not really here to spend time on that, but what I did want to share with you today is just the broader impacts, the bigger pieces that are really going to affect a lot of us and our savings capabilities. So I hope that was helpful. Really appreciate you joining me this Sunday. I hope you have a great end of your weekend, and we will be back for our next Brunch with Brandon probably in a few weeks here. Have a great weekend.